Tesla's keys to $3,000 a share are hiding in plain sight. We got to decode that shareholder meeting, call, announcement, all that good stuff. I'm Brian. Welcome to my Tesla Weekend. As a reminder, this is the live version that goes on every Friday at 7 p.m. Pacific. You might be watching this later on the condensed version. Quarter 4 and financial year 2021 update. There's a bunch of great stuff in here. Let's start here on, what is this, page 2? Check my notes, page 3. Operating cash flow, less CapEx, $2.8 billion. Nice. In total, $1.8 billion increase in our cash and cash equivalents to 17.6 Bubba's billions of dollars. Now, that may not sound like much for a very large company to have 17 billion cash on hand. That's not much, is it? Well, yes, it is. Last year, they only laid out something like $6.5 billion to get Giga's Berlin and Austin nearly to where they are now. That's most of their expense on those. That's fantastic. So I think we're looking at about $4 billion each to create factories that can produce on par with Giga Shanghai. Profitability, $2.6 billion gap. But the exciting part is the automotive gross margin, 30.6%, 29.2% excluding credits. So the good news here is that they're very profitable on cars, even without the ZEV credits. So that means if you back it out, if you cross multiply and divide, only 4.5% of the profit per car, gross profit, comes from the ZEV credits. And again, if we're going to be backing those out, we need to back them out of the fines and fees not paid by legacy makers to get to where they are. So here we are on page 4. Auto revenues, way up. Profit, way up. Margin, slightly up, despite, high expenses at the moment. Revenues, way up. Profit, up. Gap profit, up. 27.4% on the generally accepted accounting practices gross margin is fantastic. It is ridiculous. It is wonderful. All these numbers are good. You would think Wall Street would be excited about this. But, Wall Street. Total revenue grew 65%. Year over year, revenue was impacted by the following items: growth in vehicles, growth in other parts of the business. Yeah, that sounds right. That sounds right to me. Our operating income improved to $2.6 billion compared to the same period last year, resulting in a 14.7% operating margin. A lot of the problem was the hundreds of millions in Elon's compensation, which isn't real money. That isn't real money. That is just a paper figure. Although, as MD Hofste pointed out, they also had to pay $340 million in payroll taxes, which hit the bottom line in real dollars. But here's the exciting part to me. Further per vehicle cost of goods reduction. They were able to drop the price of their cars, the price that they pay to build them. Growth in deliveries, we knew about that. Improved profitability of automotive leasing and service and other businesses. Now, of course, there's that $340 million payroll tax. Raw materials cost more, increased warranty, and recall cost related to a specific batch of vehicles. Mind you, a very large batch, but a very small cost per car. Cash. Quarter end cash and cash equivalents. Our total debt, excluding vehicle and energy product financing, has fallen to $1.4 billion. And the actual debt is only like $5.4 billion. I wonder how that compares to the big guys. Oh, I don't, because I actually looked. Where did I put it? Debt in millions. I put it in the wrong spot. So let's look at the other guys. GM has 185 billion smackaroo bobs in debt. Toyota, 94 billion. Ford, 215 billion. VW. And there's little old Tesla with their little old 5.4 billion. How's that compare? Well, here's their production in millions, 6.8, 8.7, 4.2. Good millions of productions to Tesla's lonely old 0.9 million. Debt per vehicle produced. For every vehicle GM sold last year, they're carrying $27,000 in debt. Toyota, $10,000. Ford, $51,000 in debt for every vehicle they produced last year. Tesla's at $6,000. They could erase that debt. Well, first of all, they could erase it on cash on hand alone, but they don't need to. So, on page 8, all good news here. I just skipped down to solar deployment. It's up. It's way up from last year, up from the year before, down from the Solar City days, but recovering. Storage deployed, up. That's a good number. That's a good number, 4,000 megawatt hours. That's a lot of storage, and it's only going to continue increasing. More stores and service locations, a larger mobile fleet, more superchargers, more supercharger connections. These are good numbers. I don't know why Wall Street doesn't seem impressed with that. Vehicle capacity. Now this page, Fremont factory achieved record production. We believe there is potential to extend overall capacity beyond 600,000 per year. That's an old factory, man. That's an old factory. And if they can pull numbers like that, production of both Model 3 and Y continued to ramp. Local production is essential, but they didn't say anything about capacity. The earnings report still shows greater than 450,000, which of course makes sense because we know they delivered 70,000 cars in December. Well, what's the math on that? 70,000 annualizes to 840,000, and that's, they've got new parts of the factory just now being built that will come online during the year. 840 might be low. Builds of Model Ys started late in 2021 at Giga Texas, and they also started in Brandenburg, and we knew that. So the big news there is Fremont can expand. China doesn't have to expand, but it can. Just those two factories alone could get us to 1.4, 1.5 million this year, as Elon suggested in the call. But Texas and Berlin are ready. Their ramp awaits. And the last exciting one on this front is this chart. This is Tesla's market share by region. And you can see it's just increasing nicely. Not sure why there are dips here. It must be retooling. I don't know. But the exciting part is more these numbers over here. In the US, they're only at 2.2% market share. In the rest of the world, they're only at 1.5% market share in the major markets that they're in. That means the total addressable market is massive. The backlog is massive. The factories coming online will have plenty of customers available to buy the cars. Core technology, autopilot, and full self-driving. So there are now 60,000 users in beta, which would explain why I was able to get a ride in one. It appears that we haven't realized much of the revenue from that. This is what Wall Street is missing. If Tesla is first to market, or even second to market, not only can they realize billions and billions in deferred income, money that's just sitting on the books, that they can't count yet, but they'll also have a massive market. So, for example, right now the take rate is probably under 10%. So that means, I'll just do the math in my head. If you've got 2 million cars on the road, and only 10% of them have taken it so far, and now only half of the remainder picks it up, that's 900,000 cars. 900,000 cars times 12,000, that's $10 billion they could recognize immediately. And if they're making 200,000 cars a month, and half of them take it, it's 100,000 more, that's another $1.2 billion a month coming in. That would be a bit ridiculous. And now I found my chart. FSD vehicles ready, 12,000, 10 billion. At a 50% take rate, that'd be 10 billion right out of the gate. 50% of the as yet unpurchased number. Monthly production at 140,000 would still be almost $1 billion a month. And that's assuming the 12,000 doesn't go up. We have been informed repeatedly by Elon, it probably will go up. It probably will. That's what Wall Street's missing. That's what Wall Street is not accounting for yet. Well, that's good for us because we're buying and we're holding. Battery, powertrain, and manufacturing, cost of goods per vehicle dropped to about $36,000 in Q3 and 4. The average car at Tesla cost $36,000 to make. That means some cars cost less than that because you've got to factor in all the higher cost variants. And that's still selling nothing but great cars. Energy and storage. Deployments increased 32%. This is another one they're missing. They're just missing. Energy is going to be huge. The plant in Texas, Gambit Energy, made a whole video about it. When that system gets going, it's going to print money. Energy can be bigger than auto. FSD can be bigger than auto. As demand remains substantially above capacity, growth has been limited by supply. We are in the process of building a dedicated MegaPack factory. And since MegaPacks are more likely to use LFP or other chemistries rather than the high nickel, high cobalt stuff they put in cars, it's not likely to negatively impact the number of cars they can sell. Service and other increased to a paltry loss of 2.7%, nudging above break even in Q4. Why is that? Well, because the cars are coming out of warranty. As the warranties expire, you're not doing all the fixes for free. For a long time, Tesla had 80% of the cars they'd ever built still under warranty. That's a recipe to lose money each quarter. But it's also a recipe to only lose it for a little while. Outlook. We plan to grow our manufacturing capacity as quickly as possible. We expect to achieve 50% average annual growth in vehicle deliveries. So if the floodwaters are rising and you need a bunch of sandbags, you can look right here. The rate of growth will depend on our equipment capacity, operational efficiency and capacity, and the stability of the supply chain. They still have ample demand. We have sufficient liquidity to fund our product roadmap, long-term capacity expansion plans, and other expenses. Yeah, they do. And the pile kind of keeps getting bigger. While we continue to execute on innovations and reduce the cost, we expect our hardware-related profits to be accompanied with an acceleration of software-related profits. Now, this is a very subtle way of saying FSD gonna be big. The pace of production ramps in Austin and Berlin will be influenced by the successful introduction of many new product and manufacturing technologies. So what they're saying is that 36,000 we just talked about, now mind you, these are all still pretty premium cars. We haven't gone down market yet, really. But there's room for improvement. The structural front and rear castings, the structural battery pack, the 4680s themselves. These cars are going to get cheaper. And the supply chain is already getting better sorted out. So this is exciting. I assume at some point retail prices will go back down a bit, normalize as it were. But in the meantime, they're just making cash hand over fist, waiting for the rest of the industry to catch up. Page 25, they showed the Semi. You know, it's like they always say, show but don't tell. I would have appreciated a word on that, but it's coming. Cumulative profitability since inception. Losing a little bit, making money. Making so much that for the lifetime, in just 2 years of profitability, all of this has been erased. Now, can other startups survive 17 years to reach profitability? Will they have to? I hope they won't have to. I hope they will survive. But you can see the road is often difficult, no matter how grand the vision. Sometimes the vision can be too grand, and I think that's part of what went wrong. This should be exciting. Page 27 here. These are the charts that Wall Street should love. Vehicle deliveries, operating cash flow, net income and adjusted EBITDA, earnings before interest, tax, deduction, and amortization, all moving in the right direction. But the stock is down. So the call and the jitters. Some people have said Elon should not have been on the call, and I can see both sides of that. There were no new gigafactories announced. There was a pre-announcement. We will announce an announcement later this year, but nothing was announced. And I think maybe Wall Street would like to see that, since the two factories that are almost complete are, almost complete. It would be nice to see that, but I think they need to validate Tesla Factory 3.0 before moving on and breaking ground on the next one. There was no update on the CyberTruck. I was just sure we'd see that, and I think a lot of analysts were too, since the truck was brought out for photo ops with all kinds of workers and even some celebrities. And of course, no announcement on the $25,000 car. Now that, I think, is the most ridiculous of all the complaints. We don't need a $25,000 car, not right now. Like Elon said, if we had a $25,000 car, we would not have been able to sell more cars. We just would have had less revenue. There was a time when everything Elon did was a do or die moment, and as an investor, I am glad to see those days largely in the past. What was overlooked? Well, FSD was absolutely overlooked. That is a $1 trillion opportunity that's just kind of being ignored. The Tesla bot. I was a doubter. But the robot's not the hard part. The brain is the hard part. Getting a robot to clench is easy. Getting a robot to walk is less easy, but still a solved problem. Getting a robot to do human-type tasks, very difficult. But Dojo can solve it. That's what Dojo do. And of course, overlooked, the energy sector. The energy sector is going to be quite large. MegaPacks. To a lesser extent, Powerwalls. But really the MegaPacks, because Tesla can control the entire process from installation to execution, all of it. And they will start in the markets where it's most needed and most profitable, and move down from there as battery costs drop, and it just makes more sense. That's what's overlooked. So, I think it's time to get into the Q&A. What do you guys think? Yeah. And that is where the condensed version ends. If you want to see the full Q&A, which is about another 20 minutes, I think, yeah, follow the link in the description, or who knows, maybe I remember to put it in the corner, and check it out. Thank you guys so much. Stay tuned, stay juicy, and I just can't wait to hear from you clever robots on the other side.